Hello and good evening to you all, and welcome to this fireside chat discussion for public sector coming up for you tomorrow in the examination. And we just want to share our thoughts on some few things, get ourselves excited into some of the basic things that we need to understand as we get ourselves into the exam hall, and also ensure that we put you in the right frame of mind and expectation as you go into the exam hall tomorrow morning in that regard. But before I get excited, any questions for me, something specific that you want me to share my thought on? If there is anything like that, you can raise your hand and bring you up, or you can put it in the chat for me to be able to provide you some answers in that particular case. So if there is any specific question for me, something you want to pick my brain on quickly, I want to answer that before probably I get excited into the discussion. So what's up? Anything for Nhyira Premium, or we can go and sleep and get the heck out of this place? Which is which? Anything for me? Those of you on Zoom, you can put it in the chat, or you raise your hand and bring you up, certainly. And then we also live on other platforms, so whatever it is, you can put it in the chat for me, something you want me to share my thought on before we get excited into the discussion. Okay, so it means that everybody is good. Then let's just go and sleep. If everybody is good, let's just go and sleep. Like you have no questions for me, then why are we here? Let's go and sleep. PSA there, you people have learned. Let's just go and sleep and we'll be good. Or you still want me to say something? Give me more. Let me bring up my slide. Okay, so let's get into some few things in the next probably 1 hour or so and bring you some few things that you need to be mindful of when it comes to the public sector. As always, want to quickly remind you how your exam is going to be like. And so this is your syllabus, and this is how your exam is going to be like for the public sector examination. We're going to be having a question on the overview of public financial management cycle in Ghana. There are two things there: 10 marks on PFA, 10 marks on budgeting. So those are the two things you must understand there on that overview of public financial management cycle in Ghana. So 10 marks on budgeting, 10 marks on PFA. That is the deal. Then we're going to have 10 mark question covering the regulatory and conceptual framework for public sector accounting. There is a lot of material there. This is where we are looking at the measurement basis, accounting techniques, accounting concepts, like those kinds of things, and the various other introductory issues like uses of financial statements, the legal framework, and the various acts that governs public financial management system in Ghana. All of those materials, so like the whole introduction to public sector accounting and finance, starting from the beginning, all of the discussions we had in the session 1, that's 10 marks coming up, and there's a lot of material there, but we're going to be having 10 marks coming in. And so the examiner has a vast array of issues that he would want to ask you in the exam hall, but that is the second category of questions that we're going to be having. Then we go to the third one, which is going to be the IPSAS. So we're going to be having questions on the public sector accounting standards, right? So 20 marks on them. Last semester, I think the examiner brought broadly 2 questions or 3 or so, but it depends, and we'll get into some of them as we continue with the discussion. Then certainly we're going to be asked to prepare financial statement either for a covered entity or for the central government, and it could be the statement of financial performance and statement of financial position, or it could be something in relation to the issue about the cash flow statement and all of those things. So 20 marks question also on the financial statement preparation. And then we come to evaluation of the financial performance and position of the entity. Pretty important area that we need to understand. Also 20 marks. There are three options that the examiner is going to be having there, either to ask students to deal with the common size analysis, the ratio analysis, or if you want the statement of budget performance in that case. But 20 marks on the evaluation of the financial statement or financial performance and position, pretty important area there that we need to know about, and that is section E of the syllabus. And then the F is going to be governance in the public sector. So this is where we are looking at the roles of the key players in public financial management: the principal account holder, principal spending officer, auditor general, public accounts committee, the Minister of Finance, and all of the other institutions and authorities that are involved in public financial management. And then certainly the principles that we must understand when it comes to how public life is to be lived and how public people are supposed to be lived in that particular case. And so these are the things that we have to understand when it comes to what to expect in the public sector examination as we go in there. And so again, as I mentioned, if there are any questions specific, something you want to ask me about, you can put it in the chat, or you raise your hand, I'll bring you up, for those of you who are with me on the Zoom call in that particular case. But I'm going to try as much as possible to also see if we can walk through some of the major areas based on the time we have at our disposal, maybe some 70 or 80% of the areas in the syllabus as much as possible, so that we can put ourselves in the position to ultimately pass the examination. Look at this boy. He has come with causing troubles and things here. As the Nhyira place today, you will tell me who Kukwa and Ohima are. Thank you. Really? You are here for that? Come on now. Who they are? Why do you want to know Kukwa and Ohima? If I tell you who they are, obey them. Jame, let me teach. Leave me, let me teach. Alright, so let's go in there and begin the discussion. So want us to go first with the first aspect of the syllabus, which is the overview of the public financial management cycle. And so for the 20 marks area, as I mentioned, for the 20 marks area on the overview of the public financial management cycle, there are two things there that we need to understand: the budgeting, okay, and then the PIFA aspect in that case. So 10 marks on budgeting, 10 marks on the PIFA. That is the structure of the exam in that particular case. Now, when it comes to budgeting, there's a lot of material there that you must understand when it comes to budgeting. Number one, definitely, the budgeting cycle. All right. As I mentioned, the examiner may not ask you to, write the budgeting cycle, preparation of the fiscal strategy document. We formulate the budget is authorized, the budget is approved, the budget is executed, recording is done, then external scrutiny. So that's the cycle, right? I don't know, but the examiner could get goosebumps with you and say, hey, come on, give me the cycle of the budgets and explain. 10 marks. That's a nice question that I will ask if I was the examiner, but I'm not. So, but that's the idea. But if you remember, one thing that I mentioned that you have to be mindful of, which is a common thing that the examiner could get excited about under the budgeting cycle, will be the major issues or the key points, okay, or issues at each of the cycle. So for instance, when it comes to the budget formulation area, right, when we are formulating the budget, which is where it starts, there is a key thing there that has to do with number one, the budget guideline. Okay, so what are the elements of the budget guideline? And we said that this is issued to all the covered entities, showing the economic outlooks, the central government policy, how much they are allocated, that how much will be allocated to them, and what should be included in their budget, what should be the format of their budget. All of those things are, the budget guideline. So the examiner can just pick that up and ask us a question about it when it comes to dealing with the budget formulation area. And we discussed this, and you remember the various things that we spoke about here when it comes to the budget guideline. Under the budget authorization phase, we also mention that there is going to be the budget hearing. Right? You remember that, okay? That there will be budget hearing. What are the reasons for budget hearing by the budget committee at the Ministry of Finance? Okay, it allows the principal spending officers and principal account holders of the covered entities to come before. Give me a moment. Let me try to put this thing here before I pour water on my device. So the principal account holders and principal spending officers come before the budget committee of the Ministry of Finance to defend their budget. Okay, why did they include certain things? All right, and the purpose of the budget hearing is to justify the things they have done, and also to ensure that whatever they have done is in line with what the central government budget and objectives and policy in that particular case. And so the major things that are done at the budget hearing, the reasons for it, the importance of it, we mentioned that it is something you have to be mindful of when it comes to that authorization phase in that case. But also at that phase, we spoke about how the local assemblies deal with their budget. Okay, sorry, let me not say local assemblies, local governments deal with their budget. So if you remember, we said that the local assemblies are going to be preparing their budget, and it's going to be approved with a resolution, and that is going to be sent to the regional coordinating council, and that is going to be put together for the regional budget, and then boom, that is going to be brought to the national level to be able to then prepare the national budget at the end of the day. And so under the authorization phase also, it is important we understand what is happening there on the authorization phase as well, right? So what am I saying? What I'm saying here is that you have to know about everything in respect of the cycle in respect of the cycle when it comes to budgeting. That's what I'm trying to say. This is the cycle. Now this one is cycle of government expenditure. Now, this is actually in the second part of our discussion, which is the B part. Okay, because that B part, as I said, there's a lot of issues there, although we can bring it up also in the A aspect to talk about it. But this is the cycle of government expenditure. If you remember, we discussed this because we must know the cycle of government expenditure and know the various control mechanisms put in place to make sure that we control government expenditure, right? So again, we don't know whether the examiner will access this whole cycle. Now, cycle of government expenditure and the various control mechanisms is certainly different from the cycle of the budget, which we just spoke about at the end of the day. And so cycle of government expenditure, authorization first, because Parliament has to approve the budget before we can start spending. Then certainly we go to the apportionment, then we come to the reservation, then we come to commitment, we come to verification, then we come to payment. Again, this question is different from what we discussed during our mock session, where we spoke about the conditions that must be met before payments are made, as well as the processes involved in making payment. You see, public sector is a little, some way where if you don't get the context of the question well, your brain is going to be lying to you and you're going to write things that you are not supposed to be writing. So you have to be mindful of the write-up when it comes to dealing with public sector. But this is cycle of government expenditure. We spoke about this. Make sure you review that. I actually want to bring you on the government budget cycle and the various activities. So when you come to the formulation stage, three key things, as I mentioned earlier: the budget guidelines, so that now all covered entities will prepare their budget. Ministry of Finance will start preparing the national budget estimate. Then we come to the approval, authorization, then approval. At the approval stage, we mentioned that three things are going to be happening, or four in that particular case. Local government comes in, Ministry of Finance will do their hearing, reasons for the hearing, the executive approval is done, it is presented to Parliament, various committees in Parliament review the budget, and then their reports from the various committees will be tabled before Parliament, and then boom, we come in, and they come in to come and debate it, and then they vote for it. Those of you say aye. Those of you who are against it say nay, no. Then we move in that regard. So that is the authorization. Sorry, that is the approval stage. So again, know the entire cycle, number one, but then also know the major activities that is undertaken under each of the cycle. Now, when it comes to the next one, which is the budget execution, what do we do there? Like expenditures are going to be incurred, contracts are going to be awarded, right? But that is where we come to the mid-year review, because as per the 1992 Constitution, at least by 31st of July every year, the Minister of Finance must present to Parliament a mid-year budget review. Now, during that mid-year budget review, there will be a supplementary estimate, or there may be a supplementary estimate. What are the reasons for the supplementary estimate? That's also another question that we must understand as part of the budgeting cycle as we are going into the exam hall at the end of the day when it comes to dealing with those. Haji Munkwai do musuno network in Ejima. If the network misbehave, we are toasted. Oh God. Today, continue with the Nhyira Premium. Siri, I didn't call you. Okay, so I think I am back. I don't know, my network jumped up momentarily, so I should be good now, all other things being equal. Okay, so I think I was on environment. Let's go back to that. So the concept of environment is, hey, we've saved money on an line item, or we don't want to spend the money on what we had originally wanted to spend the money on. Now something has arisen and we want to spend the money on something else at the end of the day. And we spoke about the various rules and conditions about environment. You want to make sure you understand that very well. And so when it comes to the budgeting, yes, the cycle and the major activities under each of the cycle, very important. Make sure you review that. Make sure you go through that, because it's going to be playing a pivotal role in the exam hall. The second key thing here will be the other theory areas that we have to be mindful of when it comes to budgeting. Okay, so the other theory areas, like objectives of public sector budgeting, limitations of public sector budgeting, and then certainly the issue about the methods or approaches of budgeting. Okay, so what are the objectives of public sector budgeting? Pretty a lot of things there that I asked you to read on in that particular case. So, for instance, just coming into the book. So, characteristics of public sector budgeting. Annuity, because it exists just for the year. It's valid for the year. It shows the government estimate. The objectives of government budget is to maximize the welfare of the citizens. It is a document that helps so that government can be held accountable for all of the decisions that they have made during the year. It is a legal document also, so it can be enforced. It's binding on the executive and can be enforced in the court. And also it's a comprehensive document. So those are some of the characteristics of government budget. Make sure you go through some of these things. Then the importance or objectives of government budget. That's also pretty important area that we must understand when it comes to dealing with government budgeting. Then the last thing is the challenges or limitations of government budgeting, and so that's also a key area. The misconception of spending the budget and spending to the budget. It's a question that the examiner can just pull you up, and you should be able to understand what the heck that is, because one of the issues is in the public sector is that people have a misconception on spending the budget and spending to the budget. Now, when we say you should spend the budget, it means that spending in the ambit of the vote, right? So yeah, what has been approved by the budget is in the budget. Once it is in the budget, please go ahead, spend some money, you are good in that particular case. But spending the budget is where principal spending officers think that because the money or the vote is there, it has been approved by parliament, they are under obligation to spend everything. Because you know this, we've mentioned this already, that at the end of the period, if there is still some amount left in the vote, it will be relinquished into the consolidated fund. Right? And so what it means is that the covered entity is also signaling to the Ministry of Finance that, hey, you don't need more money. And so that is where many a time in the public sector, there are a lot of air quoting, right? There are a lot of useless expenses that they undertake. Why? Because they want to spend the budget instead of spending to the budget. Because yeah, parliament has approved it, so let's go spend the money. So they have a misconception of spending the budget and spending to the budget, and so that is where you see a lot of useless things that they will do, organizing training, going for workshops that never translate into any increase in public performance at the end of the day. Why? Because they have to spend the budget, and that's one of the limitations or challenges of public sector budgeting. Then certainly unpredictability in the budget assumption. Every budget has that, right? Because I mean, the budget is going to be based on certain assumptions that, hey, recently GRA is saying that they are targeting that this year they're going to make a revenue of 200 billion Ghana cedi. Now that's a bold move. 200 billion Ghana cedi, that's a bold move, bro. How are you going to get that? Yeah, maybe they've done the amount. I didn't go to any Ivy League school, so I don't have an idea about how the heck they arrive at that figure, but they've done the assumption. By June, July, then then realize that the assumption is what? Unpredictable. Yeah, we say we'll do 200 billion, but now the way the things are, we'll do 100 billion or 150 billion. That is the unpredictability nature or unpredictable assumptions, or because we are not living in a stable environment. Then time consuming. I mean, the budget is going to be pretty serious at the end of the day. I think this next week or so, the budget is going to be read for this period, and they will start preparing the budget for the next year. So realize that it's like every time we are preparing the budget and we don't get time to execute the budget, and may not be flexible, because if we have to change anything in the budget, sometimes the Minister of Finance can do that virement, but some virement will require parliamentary approval. So you have to come back to Parliament to seek approval before it could be done at the end of the day. And so those are some limitations there, and you want to make sure you are mindful of that. Then certainly we come to the methods of budgeting, right? Incremental budgeting, zero-based budgeting, program-based budgeting, activity-based budgeting. Make sure you read through all of those things. So when it comes to that 10 marks area on budgeting, as I mentioned, there's a lot of material there. But as I say, as always also, if you're a good student and you have been studying all this while, that ain't gonna be a problem at the end of the day, because now you are just cruising out here and there are just some few things you have to highlight, and then boom, you're gonna be good at the end of the day. So that is public sector budgeting, 10 marks waiting for us in the exam hall that we have to be mindful of. Any questions or follow-up or clarity on anything under this area? Can raise your hand, I bring you up, or you put it in the chat for me in that particular case. If there is any question or follow-up that you have for me on that 10 marks area budgeting. Then we go to the second area, which is PIFA. 10 marks waiting for us in the exam or on PIFA. And we said there is a lot, again, that the examiner could access here. So what are the options available to the examiner when it comes to PIFA? In other words, what is in the syllabus that we have to be mindful of when it comes to the public expenditure and financial accountability framework? Remember, the public expenditure and financial accountability framework is a framework or tool that is used to evaluate the efficiency and effectiveness, or puts in another way, the weaknesses or strength of the public financial management system of the government. That's what the PIFA framework is for. So whatever public financial management system that has been put in place by government, in collection of revenue, in management of debt, in preparation of their budget, in the execution of the budget, in the auditing of financial statement, in the preparation of the financial statement, all of those systems put in place, we want to assess, are they effective, are they efficient on each of the various items mentioned? That is what the PIFA framework is looking at generally. And so under this, we mentioned that there are a couple of options that the examiner has available, and we went through some of these things during our revision session. Certainly the objective of the PIFA framework, objectives or the importance of the PIFA framework, what it's covering, what it is telling us generally. All right, pretty important at the end of the day. Number 2, we spoke about the limitations, okay, or challenges of the PIFA framework. All right, number 3, it's going to be the critical performance dimension. Can't even spell critical. What kind of school did this guy attend? Critical dimensions of an open and orderly public financial management system. Now remember, we mentioned that this critical dimensions of performance in respect of open and orderly public financial management system, there are 6 of them, and they look alike with the 4th aspect, which are the 7 pillars. Remember, we highlighted on this, right? Let me bring that up as well quickly, so we see, because again, the context of the question will determine what the heck you are supposed to do generally at the end of the day. It's like I'm in a different document instead of my regular document. Give me a second. Let's see if I can pull up the right document. Oh, what's up? Okay, PSAF. Okay. Okay. So let me show you quickly. Yeah, this is the document we want to be in. What the heck? PIFA. Where the heck are you? There we go. Okay. This one. Critical performance dimensions of an open and orderly public financial management system. The concept of credibility, right? Comprehensiveness and transparency, policy based, predictability and control, accountable, recorded, and then external scrutiny and audit. This one is different from the 7 pillars. The 7 pillars. And so you want to make sure you understand. When the examiner says 7 pillars, you are talking about budget reliability. You're talking about transparency of public finance. We're talking about management of assets and liabilities. We're talking about policy-based strategy and budgeting. We're talking about predictability and control in public sector or budget execution. We're talking about accounting and reporting, and certainly external scrutiny. Those are the 7 pillars that we use to measure the performance of government in respect of the efficiency and effectiveness of the public financial management system in place, right? So what are the objectives, importance, or reasons? What are the limitations? Then the critical dimensions of the open and orderly public financial management system. Then the 7 pillars. So on the written side of things, these are the options available to the examiner when it comes to PIFA framework. Then we go to the other side of things, which is going to be calculation and interpretation. Okay, the other side of the PIFA, calculation and interpretation. Calculation and interpretation. Okay, what the heck are we talking about here? If you remember, that is where we came up with these 2 concepts, that in the public sector, when it comes to the PIFA issue, first we're going to be looking at certainly using the pillars, right, that we are looking at. Either we are analyzing budget reliability, policy-based budgeting, reporting, external scrutiny. Whether we are evaluating all of those things or not, we can use either the weakest link method M1 or the average method M2. Now remember the guiding principle about M1 and M2. The examiner can access a question about the issue in respect of defining what the weakest link method is and what the average method is. We could be asked. And so if you remember in our PIFA document that we shared with you during our discussion of the PIFA framework, let me see if I can just bring it up so you understand what the heck I'm talking about. Yeah, this particular document, the PIFA kit, we gave you the definition of what the weakest link is and what the average method. The idea is pretty simple. With the weakest link, what is happening here is that a negative result in one dimension will cancel off a positive result in another dimension under the same indicator. That is the weakest link method, M1. The average method is where we are looking at just the arithmetic average of the score, and that is all. And so it depends on the context of the question and what the examiner wants us to do. If he wants us to use the weakest link, then the rule is that we start naming with the lowest score. Now, our score is A, B, C, D. Numerically, A is 4, B is 3, C is 2, and D is 1. The interpretation is that A means very good, B means good, C means average, D means you suck, poor. And so in the weakest link method, remember the guiding principle we mentioned. We said you're going to be starting the scoring with the lowest item there. So if we are looking at a couple of things in the discussion, okay, say we are looking at a couple of things in the discussion. Let's say we are looking at reporting. And then timeliness of the reporting is one of the dimensions there, and there is a score of C on that. Then we have application of maybe the IPSAS, we have a score of B. Then we have what else? Usage of the GIFMIS, we have a score of whatever, let's say A, and we are using the weakest link method. What will be the score for the recording and reporting pillar? What will be the score for that? If we are using the weakest link, we start with the lowest. So if we look at these three things here, the lowest is C. So we start our scoring with C. But if you can check, there are B is higher than the C, A is higher than the C. So because there are two highest like that, our score is going to be C plus, which means that's an average what? Performance. That's the meaning of the weakest link. So if we start with the lowest, that's why I'm giving you an example here. So it will be C, but since there are some positive B above the C, we are going to add a plus. So it becomes C plus. Now the plus doesn't change the scoring because it's still C, which is an what? Average score. Now, if we're not, so this is M1, weakest link. If we're not using M1 weakest link and we were using the average method M2, what do? We will take the average of what the heck is happening here. Again, if you remember the numbers, A is 4, B is 3, C is 2. And there are 3 items there. So my average under M2, it's going to be 4 plus 3 plus 2. That's going to be about 7 plus 2, 9 divided by 3 is 3. Right? So 7 plus 2, 9 divided by 3 is 3. So under the M2 average method, we are getting 3. Where does that fall? The 3 is for B. So under the average method M2, our score is B, which means this will be what? Good. That's all. So that's the difference between the weakest link method and the average method. So that is the first style of question that the examiner can bring to us when it comes to the calculation and the interpretation aspect. Okay, M1 and M2, you interpret. Then there is another style of, there is another question that the examiner can ask you. How should or what should the government do to improve the performance? So maybe there is a particular dimension or an indicator which is overall average or maybe poor. What should we do about that? What measures should be put in place? The examiner can access that. So dealing with the M1 and M2 weakest link and average method, interpreting it and then giving recommendation is something that the examiner can access in that particular case. Then we come to the next one in the discussion. Please give me a sec. And the second thing that we need to understand about the calculation and interpretation is the preparation of the statement of, budget performance. You know this already. We did it. We wrote analysis about it. So preparation of the statement of budget performance. So this is where you are preparing your budget performance, you know that already. We bring in the original budget, right? If there is a revised, if there is supplementary estimate, then we'll add it or adjust it with the original budget so that we can now come up with revised budget. If there is no supplementary estimate, then the original budget is what we are going to be using in that particular case. Then we bring in the actual results, right? Then we bring in the out 10. Then we can have, so we can have the out 10 in percentages. Then we will have the score here. So this is statement of budget performance in the PIFA environment. And if you remember this question we solved in class, the scoring guideline will be given to you. So you remember we said your out 10 is your budget minus the actual over the budget multiplied by 100. Now you can decide to do the out 10 even two columns under that, meaning out 10 in currency, out 10 in percentages, whatever the heck, right? But just stay with the percentages. But you know, whatever it is you want to do, you can do that as well. But that is the out 10 calculation. Then you have the score, and the guideline of the scoring is going to be given to you. If you remember the question we solved in class, a TUM district assembly or a TUM district assembly or whatever the heck, yeah, this particular question, the guiding principle was given to us based on the context of the question. Remember the way we addressed this particular question, looking at the fact that we are working for just the first quarter, and so we needed to calculate the budget for the first quarter and then use the ratio allocation given to us here. Remember the way we deal with it. Because as I say always, if you don't understand the context of the question, then you're likely to go screw yourself up. Although on the overall, you could work out what the examiner is asking you to work out. So that is the statement of budget performance, and then we interpret in that particular case. So when it comes to the PIFA 10 marks area also, these are the things that we need to understand. Now remember, again, we spoke about the interpretation guideline. I'm going to be coming back to that proper when I'm looking at the evaluation of the financial statement in that particular case. But that is the idea about PIFA and also what we need to understand. Now I don't know what the heck the examiner will do. He could decide to go purely written and pick your brain on some of the pillars or critical dimension, the limitations, the objective, whatever the heck. Or you could decide to go fully to the statement of budget performance, 10 marks, or maybe up it up a little bit, maybe 15 marks to pick your brain in that particular case, in that regard, for you to work yourself out. Or he would do a little champer, some calculation issue like he did last semester under the concept of M1 and M2. He brought the thing and asked students to do the interpretation in that particular case with a theory coming up. So either the examiner could say that, hey, I want to pick your brain a little on some of the theories, and then pick your brain a little on also some of the calculation issues. But these are the things we must understand about the PIFA framework, the 10 marks area that the examiner is going to be bringing to us. Like I tell you all the time, it's about knowing what is in the syllabus and then the options available to the examiner. And then my goal ultimately, as we've been doing over the last 12 weeks, if you've been in the class, is to let you understand even the context of the question, like the way the examiner is going to be setting the questions. And that is why I am going the way I'm going, just to let you have an idea about what you're expected to do in the exam hall generally in that particular case. So that's the idea about PIFA, and this with the budgeting gives us 20 marks. So any questions, something on the PIFA that you want clarity on beyond what I mentioned, you can put it in the chat for me, or you raise your hand, I'll bring you up if there is anything you want clarity on in that case. So please make sure you read on the pillars, right? We've simplified this. We've discussed this over and over again, what each of the pillars are looking at generally. And then certainly the issue... what's wrong? What the heck? And then... and then certainly the critical performance dimension that you need to be mindful of in that particular case. So that's PIFA, 20 marks, boom. That's all about that, and that's what you need to know about. All right, so the question is, how much of these do you have right now off head? How much of these do you have right now? We hope that you have a lot in your brain. Okay, so that's the first part of our discussion, the 20 marks area. The second part of our discussion, session B of the syllabus, that's the regulatory and then the conceptual framework. As I mentioned, there is a lot of material to go through under that particular area of the syllabus. Okay, under that particular area of the syllabus, the regulatory. Can't even spell regulatory. So regulatory and conceptual framework. Now there's a lot of material here. I cannot go through all of them, but I'm just going to be getting goosebumps on just a few of them for this 10 marks area that we need to know about. Certainly you want to understand the measurement basis, right? The way we measure items. There's a question like that the examiner can ask you. If those of you with my book, there's a question like that in the book on the measurement basis. I don't know, let me see if I can bring it up in record time. If not, then I can just skip it. But there's a question somewhere. Oh, Nhyira, can you find this? Yep. Yeah, this question. So those of you with my book, for instance, 37, page 37, this is a sample question on measurement basis, because remember, the measurement and recognition of the element in the financial statement is part of that 10 marks area. So what are the various measurement bases? Fair value, historical cost, replacement cost. Those guys, know their definitions. Beyond knowing their definition, this is a sample question on alternatively how the examiner could hit you up with, where an entity is trying to determine the value at which they will carry a human resource software that they developed in-house, stocks of books in their library, and then vehicles that has been donated to them. So what will be the way they should be measured? So those of you with my book, this question is there with a solution. You can look at it, because measurement basis is a crucial aspect in that 10 marks area when we are talking about the regulatory framework issue. So please make sure you read again on all the measurement basis. Okay, historical cost, replacement cost, the fair value, the net realizable value, the value in use. Know the one-liner definitions. Then alternatively, how the examiner could set the question, like what you see here in my book. Okay, so that's the first thing, measurement basis of the items in the financial statement. Then the second thing has to do with the basic issue on recognition of revenue and expenditure. Now, when it comes to recognition of revenue and expenditure, this is where we are talking about the accounting basis. Okay, the accounting basis. So the way we recognize revenue and expenditure, we use the accounting basis. And you know this from KG2 already. I'm not the one to come and teach you that here again. Cash basis of accounting. What is the cash basis of accounting? This is where revenue is recognized only when cash is received. Expenditure is recognized when cash is paid. So there are two things you must understand when it comes to the revenue recognition and expenditures. One, know the theory parts. Okay, so cash basis, accrual basis, modified cash basis, and then modified accrual basis. Now, know the theory definitions of these things, their advantages and disadvantages. But in addition to that, remember we solved the question in session 2 when we're talking about these things. I don't know, I think session 1 or session 2, on where a certain financial statement was prepared on accrual basis, and the question asks us to redraft the financial statement on cash basis. So that's also another style of question that the examiner can present to us. Another style of question the examiner can present to us is also what we discussed during our mock session, which is where the examiner will say, how should the following be accounted for? I think I showed you the question even in my book, if my memory serves me right. Yeah, this particular question 2 in the book. Right? So how is revenue recognized under the cash basis? How is capital expenditure recognized? So under cash and accrual basis, how are these items recognized? So two things here. It's a very bulky area, only for 10 marks, but the two things here that you have to be mindful of is, or three things under this accounting basis, is know all the theories, which I think you should know by now. Number 2, the financial statement may be prepared in an accrual basis, then they will ask you to redraft it on a cash basis. Or a financial statement will be prepared on a cash basis, the examiner will ask you to redraft it in accrual basis. That's a second style of question for the examiner if he wants to dance with you here. Then the third style of question is this one, where the examiner will want you to distinguish between the accrual basis of accounting and cash basis of accounting based on certain items and how they must be recognized in the financial statement. So that is the idea about the recognition of revenue and expenditure. Please make sure you understand this. Recognition of revenue and expenditure, accounting basis is about recognition of revenue and expenditure. That's very important to me. Now, in the accrual basis, you know that in KG2, we recognize revenue and expenditure not when cash is received or paid, but when the transaction takes place. And so under the accrual basis, we will capitalize assets, we will charge depreciation, we will make provisions for contingent liabilities and all of those other items. Yes, we do all of those in the accrual basis of accounting. Then you come to modified accrual basis. What the heck is there? This is where the books are left open 3 months after the end of the year to capture transactions that relates to the year just ended, for which payment or receipts are made after the end of the year. That's the modified cash basis. So it is the same cash basis though, but whereas the financial books would have closed at December in the original cash basis model, in modified cash basis, we're going to left the books open 3 months after the end of the year to capture those transactions that had occurred in the 12 months ended, for which payment or receipts are now made in that current 3 months after the end of the year. So that is modified cash basis. Then modified accrual basis is where we are using two different accounting bases. So when it comes to revenue, we recognize the revenue using the cash basis of accounting, and then when it comes to the expenditures, we're going to recognize the expenditures using the accrual basis of accounting. So again, this is a non-negotiable area. As a student in public sector, measurement basis, you must know it. As a student in public sector, recognition of revenue and expenditure, you must know it. It's a non-negotiable field. And as I said, the style of the questions is very important, because you must know the context of the question and how to dance your way to the music or tune of the examiner. So that's the second thing here: revenue recognition and expenditure recognition. We use the accounting basis and concept. 3, we come to the keeping of records. Okay, keeping the financial statement, or if you want, records. When it comes to keeping financial statement or records, this is where we use the accounting techniques or approaches. The accounting techniques or the accounting approaches. And you remember these guys, right? Who doesn't remember? Your friend, vote or appropriation accounting. Commitment accounting. Ebaze. What's the other one? Fund accounting. And then environmental accounting. So these are the accounting approaches. Again, what is the style that the examiner can ask this question? Just like this, the examiner will want you to, explain what the heck these guys are, or differentiate between them. That's the first style. Then the second style is a calculation question, which I asked you to look at in the summary videos, which I hope you did. So that's the second style of question, where we are going to be preparing the vote account, the commitment account, and the expenditure account. And that's a calculation related question. If the examiner get excited, then he could throw you in that jungle for the 10 marks in this segment of the syllabus. Okay, but vote accounting, this is where we are keeping the records based on the budgetary estimate approved by Parliament. Does that make sense? So we are keeping records based on the budgetary estimate, okay, approved by Parliament. All right, approved by Parliament. Now, there are key features here you must understand. I will not go through these, but make sure you understand the key features. But that is vote accounting or appropriation accounting. Commitment accounting, here we are keeping the books based on contracts that has been awarded. Okay, so evidence by contracts that has been awarded, okay, or purchases orders that we've sent out. And this is a fundamental rule when it comes to the Public Financial Management Act 2016, Act 921. Basic commitment accounting. So immediately we award a contract or we sent out a purchase order, we move the money from the vote into the commitment. That's where the calculation question I asked you in session 2 to review, and during our revision also I referred to it, and tonight also I'm saying it. It's about, I'm not saying if you have not watched it, go and watch it. I'm not saying that. You decide whatever the heck you want to do. But so the rule is that immediately we award a contract or we send out the purchase orders, we move the money from the vote and put it into the commitment. Then when the supplier brings the goods or the service provider renders the service, an invoice will come. So when the invoice comes, we now move the money from the commitment into the expenditure account. Now, two things may happen. Maybe the actual invoice that came will be more than the amount we had put in the commitment, and it has been approved. So maybe when we awarded the contract, it was $10 million. But by the time the person executed the contract, it is now $12 million. And that extra $2 million has been duly approved. Then in that case, since in the commitment we had only $10 million, the extra $2 million must come from the vote. So we move the 10 million from the commitment into the expenditure account. Then the extra 2 million must be moved from the vote into the expenditure account. The reverse is true. When the invoice comes and it is less than the amount on the contract and the service has been provided and there is no issue, then it means we will only move the amount that the invoice came for the invoice from the commitment account to the expenditure account. then the excess over the invoice will be taken back into the vote account in that particular case. That's the concept of commitment accounting, and this is a cardinal issue in public sector. Every covered entity that doesn't use the commitment accounting techniques has violated a provision in the Public Financial Management Act 2016, Act 921. And that's commitment accounting. We are keeping records, evidence by a contract that we have awarded or a purchase order that has been sent out. That is the issue in respect of that. 3. Fund accounting. You know that already. This is where we are keeping separate books of accounts for each of the public funds, because we see each of the public funds to be an independent entity, so that at the end of the period we can know the assets, liabilities, and balance on the funds. That's fund accounting. And what are the public accounts of Ghana? The consolidated fund, the contingency fund, the road fund, the covered fund, and the other funds, and all the other funds, right? So keeping separate books of accounts for all these, fund accounting. Then certainly environmental accounting. It is incorporating the environmental implications of government revenue generation into the accounting system of the government. And so when it comes to the way we prepare or keep financial statements or keep records, then we are going to be relying on the accounting techniques or accounting approaches. Again, this is in that 10 marks area. So that's why I said there's a lot of issue here that examiner can get goosebumps on. Measurement basis, recognition of revenue and expenditure, accounting basis, keeping of financial statements or records, that is accounting approaches in that particular case. Then other issues still under this area will be the legal framework. Okay, what are the various laws that governs, public financial management system in Ghana? And you know some of these things already, right? The 1992 Constitution, the Public Financial Management Act 2016, Act 921, the Audit Service Act, the Financial Management Regulations Act, LI whatever is it, 2378, like those things, you know them. That's also something the examiner can ask you about in that particular case. Then certainly users of financial statements, objectives of public sector organizations. So all those introductory baby talks that we did in session 1 of our discussion, all that is what is captured under this 10 marks area that the examiner could get goosebumps on for you. Again, just a lot of materials there, but these are some of the key things that we need to really understand. Measurement of elements in the financial statement, recognition of revenue and expenditure, keeping of records using the accounting approaches, the various laws that govern public financial management system in Ghana, uses of public sector financial statements, objectives of public sector entities. All of those encumbrances will be applicable in this area of the syllabus and in the exam hall for 10 marks. Any questions on this for me? Any questions on this for me? Something you want me to, clarify under this, if you have any? In that case, okay, let me see, because we are also live on YouTube. I don't know if I can look at some of the comments. Okay, so on YouTube I have some comments coming up. Let's see if I can take them. Which one is this? It says Nane Equia. Please touch on how to solve the budget question you projected using the ratios they gave. Which budget question did I project? I don't think I've projected any budget question here. Did I project any budget question using the ratios they gave? I don't think I projected any budget question on an ACA. Whatever, I don't know. Maybe you can clarify to me if I've forgotten. Comfort tech, whatever, texting. Please, can you show to use ratio apportionment on the budget? Did I project any budget issue? Did I project any budget question? I don't know. Have I brought up any budget question? During the discussion of the budget, I didn't bring any budget question. Where the heck are you guys getting this from? Which one? She's talking about the PIFA question. Okay. Oh no, I can't solve any question here, unfortunately. This, where we are now, it's not about solving question. So unfortunately, I can't solve any question. I'm just here to share my thoughts on concepts, then we get excited and go away, because I can't get into solving questions, unfortunately. Okay, unfortunately, we've already solved that question in class and discussed it, so I can't solve it again, because if not, then we will be using more time than required in that particular case. Who is this? Sia Belly Joy, whatever. Forgive me if I don't mention your name right. Hi Nhyira, thank you. In Zimbabwe, you really helped me in my undergrad. Hope to work more closely in my ACCA journey. That's great. Congratulations, and wishing you all the best as you go on the ACCA journey. Okay, yeah, I think. Okay, so I think these are some questions here. The one with the annual budget and the first quarter. Okay. Yeah. Like I said, unfortunately, I wouldn't be able to solve any question because, we don't have time for that, for me to solve questions here. But the idea about that question, where is it? This particular one, the Etum District Assembly thing, I could just talk about the way the calculation is done. Okay? I could just talk about that, but not solve it. But we were given the annual budget, right? But the actual is to match. So the context of this question, we are supposed to prepare the statement of budget performance, and then we'll analyze the budget performance. So the budget is for the year, but the actual is for the first quarter, and we are working for the first quarter. And so the question then is, we need to share this one. The budget which is in annual, we need to get for the first quarter, and we are told that the budget allocation over the various items over the quarters is in the ratio of this. So over the quarters, it is 3:3 2:2. What does that mean? It means the first 3 is for Q1, the second 3 is for Q2, the third 3 is for Q3, the fourth 3 is the 2 is for Q3, the second 2 is for Q4. So since we are working in Q1, when we add all these up, it becomes 10. So to get the results for Q1 is 3. So we'll just do 3/10 multiplied by each of the budget items, 3/10 to get the budget for the first quarter. Then we now compare with the actual, and then you put that in this particular statement form in that case. So the 3/10 times the annual budget issues will come under the original budget. There will not be a revised budget here. Then you bring the actual, then you get your out 10, then you bring your score in that particular case. So that is how you get the budget in this ratio context. Sounds good? So I think that was what you were asking. That's what I can say there in that particular case. Yeah, so I've touched on the ratio in that regard and how it is done. Nana ekia yamwa. Nana ekia. Okay. So I think that's okay. All right. What else we got? Let me go. So that's our regulatory and conceptual framework, 10 marks area that we need to understand. So that's the second part in the syllabus. Third is my favorite area, application of the IPSAS in the financial statement preparation. 20 marks question will be on the IPSAS. And we've looked at all the IPSAS. Oh, sorry, not all, but most of the IPSAS as per our discussion, because we can't look at all of them based on our discussion. And so we have some of the videos on the others also available in the mobile application, which we asked you to watch as well in that regard. But if you remember, we said when it comes to the IPSAS, so we'll have a 20 marks question on the IPSAS, but also the IPSAS will help us in the preparation of the financial statement. So give and take, as you know already, this is 40 marks. If I don't get too much goosebumps, I can say the IPSAS is 40 marks. Just like how in financial reporting, the accounting standards 40 marks for financial reporting students minimum. Here also 40. Why? Because we will have 20 dedicated. Then when it comes to the financial statement preparation, all the footnotes 99.9% of the time will be an IPSAS issue, that we have to deal with. And so we mentioned the key IPSAS that you have to walk away from, or that you have to know about before you enter the exam hall tomorrow to increase your chances of passing the examination. IPSAS 17, property, plant and equipment. IPSAS 16, investment property. IPSAS 12, inventories. IPSAS 19, provisions. IPSAS 1, the presentation of financial statement. IPSAS 2, the cash flow statement. Because if you remember, when it comes to the financial statement preparation, either we're going to be having a covered entity, or we are going to be having the central government. Either the examiner wants us to prepare statement of financial performance, which is the same as statement of revenue and expenditure and financial position, or the examiner wants us to prepare statement of revenue and expenditure and the cash flow statement. And we've discussed this. You saw the way we dealt with the various things there about the cash flow statement preparation. Operating cash flows, investing, and then financing, the various things we spoke about. Then certainly the 3 revenue recognition standards: IPSAS 23, revenue from non-exchange; IPSAS 9, revenue from exchange; IPSAS 11, recognition of revenue from construction contracts. And I just told you something about current development, that there's a new standard that is coming up in that will be effective in January 2026, which is IPSAS 41, and it is replacing all these 3, just like IFRS 15 came in the private sector situation. But that's just a current information thing. So those are the key IPSAS that, baby move, we have to know about it. Beyond that, IPSAS 4, effects of changes in exchange rate. Now, the truth of the matter is that, as we know already, most of these IPSAS can be flipped in the private sector. So if you look at IPSAS 17, for instance, it's like IAS 16 on steroid. IPSAS 16, investment property, is like IAS 40 excited. IPSAS 12 is like IAS 2 excited. IPSAS 19, provisions, contingent liabilities, contingent asset, is like IAS 37 in the private sector, right? You come to the IPSAS 4, effects of changes in foreign exchange transaction. That is IPSAS 21. Okay, then IPSAS 31, intangible asset, that's like IAS 38. IPSAS 14, event after the reporting period, is like IAS 10. IPSAS 5, borrowing costs, is like IAS 23. IPSAS 3, accounting policies, changes in accounting estimates and errors, is like IAS 8. IPSAS 41, financial instrument, is like IFRS 9, IFRS 7, IAS 32, financial instrument, and some of the other IPSAS in that particular case. So a lot of issues here in that regard. Certainly, I'm not going to be going through all of them. I'll just maybe do a highlight on some of the key ones that we need to understand. But before I get there, is there any specific question? Don't tell me to teach everything in a standard, but if there's any specific question you have in any standard listed here or not listed here that you want to pick my brain on, that you want to ask me question about, you can, raise your hand. I bring you up, those of you with me on Zoom, or put it in the chat for me as well. Is there any IPSAS here that, as you are revising, it is doing you that you want something specific to be said or mentioned about in that particular case? Anything? And now everybody is in a comfortable lead. Oh, I love it. 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 I love it that everybody is in comfortable lead. Then in that case, there's no need for me to talk about anything again here in that particular case. Let me just, what the heck in IPSAS 11? When you say IPSAS 11, you've not said anything. So, like I said, I'm not teaching everything here, right? So, what in IPSAS 11? That's coming from who? Jeff Ty, right? Yeah. What in IPSAS 11? Certainly, we can't run the whole show. So, what exactly in IPSAS 11 that you would want to know about in that particular standard? So you can give a clarity on that for me. Then I could look at it as well in that particular case. Now, so I'm going to link this a little bit to the financial statement preparation, then we'll jump it up and then expand on the discussions in that case. And so when it comes to the financial statement, we mentioned that either we're going to be dealing with a covered entity. Okay, that is an entity whose activity is financed either in part or in whole from the consolidated fund or by the central government. That's a question the examiner can ask you. So you got to be mindful of that as you are looking at the discussion there. And then for the central government on the consolidated fund, right? Now, what is the distinction between these two guys? It's first the revenue. Okay, so when it comes to a covered entity situation, the revenue is categorized into decentralized transfers. This is the money that the covered entity received from the central government. Okay, so any money they receive from the central government will be deemed decentralized transfer or will be brought under the decentralized transfer. Remember, if the central government also makes some payment on their behalf, that thing will be treated in two. In that particular case, it will come under the revenue in decentralized transfers, then it will also come under the expenditures, that same item. So, for instance, when the central government pays for the wages and salaries on behalf of a covered entities, they are supposed to have given them the money so that they will make the payment. And so, since they didn't give them the money and they've made the payments on their behalf, the money will be, we have to recognize it under the decentralized transfer. Then that same figure will be brought also under the issue in respect of compensation of employees. But that is the first item about revenue, decentralized transfers. Then we come to internally generated fund, IGF, because many of the covered entities are empowered. If we come to the local government, they are empowered by the Local Government Act. When it comes to ministries, departments, and agencies, there are various acts that permit them to charge for their services or to earn some money on their own. And hence, in that case, IGF will come in. But if you remember, we mentioned that even the IGF can be categorized into certain groups depending on where the heck we are at. So we could have issues like licenses, so that everything about licenses comes under that. We could have issues about rates, so that property rate, basic rate comes under that. In that regard, we could have issues about investment income, which is where interest received on investments or dividends that they receive, if there is any, will come under that particular category as well. But IGF is the second thing, internally generated fund. And then certainly they're going to have grants and donations, because yes, the entities receive donations. So any donations they receive, we have to bring them in. Now be mindful here, because that is what I was telling you earlier when we started in the session 2 part of the syllabus, what we looked at previously, because we will be calling on the measurement basis probably here, because when you are preparing the financial statement, you must know, is it on cash basis, is it on accrual basis, is it on modified accrual basis? Then you know how to deal with various things in the notes. That is very important. So don't just that you are going accrual there be. The examiner can ask you that the entity is using modified accrual basis, and you must know, if it is modified accrual basis, then that means that any revenue outstanding in the notes which is yet to be received by the entity cannot be recognized, because in modified accrual basis, revenue is recognized on cash basis. However, in the footnote, if there are certain expenditures that are outstanding, we will recognize them. Why? Because in modified accrual basis, the expenditures are recognized on accrual basis. So when it comes to the financial statement preparation, it is important we understand, how is the entity recognizing revenue and expenditures? The examiner will tell you in the question, and you must know it, so you know what you're supposed to do. By default it should be accrual basis, but as I told you earlier, the examiner doesn't owe you anything. There are certain covered entities that are still using cash basis. There are some covered entities that are using modified accrual basis, whilst there are some that are using the accrual basis, because the transition is in stages, is in phases, and we have not fully transitioned into full accrual basis. And so still the knowledge of cash basis and modified accrual basis is necessary. So please be mindful of that. If not, you are on your way to Zokbo in this particular area. Zokbo 0. So grants and donations. Now you got to be careful. Sometimes we could receive, or the entity could receive, how do we call it? Donations in kind, right? And so if you remember the way we deal with the issues, donations in kind. How do we account for this? Now, that there are two, or the basic accounting standard we start with is certainly going to be IPSAS 23, revenue from non-exchange transaction. Okay, what is the rule? We need to determine the fair value of the item that has been received at the date. Okay, so the fair value of the item. If it is an asset, or let me put it this way, maybe it's an equipment, or maybe it's an inventory of something, sanitary pad or condoms or whatever the heck, we determine the fair value. That's the first thing. Now once we know the fair value, then we pass the journal entry. Please note that journal entries are here. Journal entries, we've dealt with these things. So that donation in kind, so this is an example, maybe whatever the heck, Ministry of Health receives sanitary pad and condom from UNICEF. Okay, all right, that's IPSAS 23. That's donation. So at the date of the receipt of the sanitary pads and condoms, we determine the fair value of the sanitary pads and condoms, and then we will debit whatever the heck. Okay, sanitary pads and condoms will be inventories of those things. If it's an equipment or whatever the heck we received, we're going to debit it. Right? Then you credit revenue. But you're not just adding it to any revenue. You are adding it to grants and what? Donations. So that's our initial measurement and recognitions. Now, so the initial measurement, we are applying IPSAS 23, revenue from non-exchange transaction. We determine the fair value and incorporate it in the books. On subsequent measurement of such things, we're going to be applying the respective IPSAS, or if you want, the applicable IPSAS in that case. So for instance, if it is inventory of sanitary pads and condoms we've received, then that is inventory. So on subsequent measurement, the inventory of sanitary pads and condoms will be carried in accordance with what? IPSAS 12 inventory. Now when it comes to IPSAS 12 inventories, there are two ways inventories can be measured depending on what is happening. If the entity is going to resell the inventory, so if the inventory are for sale, then the inventory will be carried at a base, lower of cost, and then the net realizable value. If they will be selling it, then we carry it at lower of cost and net realizable value. However, if they won't sell it, so it's for free distribution, or they're going to be using it in their day-to-day running of the organization, then that will be carried at lower of cost and replacement cost. So that is IPSAS 12. And this is going to be happening in the footnotes. We don't know the kind of question the examiner will hit you with, but if there are some inventories that must be valued, then the examiner will hit you with that in the footnote. So you must know, if I'm giving the cost of the inventory, the net realizable value of the inventory, the replacement cost of the inventory, which one should I use? It depends on what inventory we are dealing with. If the entity will resell the inventory, lower of cost and net realizable value. If it is going to be distributed for free, or the entity is going to use that in their day-to-day running, then certainly we're going to be going for lower of cost and then net realizable, lower of cost and replacement cost. So in my example here, the inventory of sanitary pads, that's how we're going to be accounting for it in that particular case. Now note that the cost of the inventory consumed during the period will be part of goods and services. When we come to the expenditures in the financial statement, one of the line items there as per the chart of accounts of government is goods and services, or use of goods and services. And so the cost of the inventory consumed during the year comes under goods and services. Now, if it wasn't sanitary pads and condoms that we received, and we received equipment, then it means that the equipment will be carried in accordance with IPSAS 17, property, plant and equipment. Okay, now if you remember IPSAS 17, the initial cost of an asset shall be the purchases cost plus all other directly attributable costs incurred in bringing the asset to its present use. So if you remember, we solved a question in class where we were told that the government bought some ambulances, right? And then we determined the initial cost of the ambulances, and then we did the calculation. There were things we included, some useless expenses like, the cost of putting the national emblem on the ambulance, the commissioning of the ambulances, the training of people to use the ambulances. We don't care about all that. All these will be written off, because whether you commission or you put national emblem or whatever the heck, the ambulances are ready. They can carry sick people. Right, so that's IPSAS 17. But on subsequent measurement, if you remember, we mentioned that the assets could be carried either using the cost model or the revaluation model, and then depreciation will be charged. And the depreciation can be either the straight line method or reducing balance method. With the straight line method, we are calculating the depreciation over the cost of the asset. With the reducing balance method, depreciation is certainly going to be calculated using the the carrying amount of the asset. And so those are the two models that we need to know about, the cost model and the revaluation model. Now, where assets are revalued, if for the first time we did a revaluation and there is a revaluation loss, then it will come in the statement of financial performance as a line item under other expenses. Okay, as a line item under other expenses in that particular case. But if we did revaluation and there's a revaluation surplus, that will come in the net asset movement, because the revaluation surplus will then come on the face of the statement of financial position. So that when you come to the statement of financial position, you have the accumulated fund there, then you have your revaluation surplus also coming up there. So that is the concept of IPSAS 17. So this donation in kind, initial recognition, IPSAS 23 going to be applicable, but on subsequent measurement it will depend on what the heck we are dealing with to be able to account for it in that particular case. Sounds good? Now, we could also have donation in kind for expertise or services, right? Donation in kind for expertise or services. So this is where, instead of giving us money, okay, or giving us assets, the country or the donor gives us expertise. Okay, so whatever, recently there is an outbreak of cholera in some part of the world and some other, type of sicknesses around the country, and so whatever, a certain NGO could come in, or a certain country could come in and say, hey, we are bringing you some doctors to help fight this cholera or these outbreaks in that particular case. Okay, hold up. The same rule is going to be applying here. We determine the fair value of those experts. So if we were paying them, how much will we have paid? So the same rule is going to apply. We determine the fair value. That's it. So once we know the fair value of the expert, debit your, this is going to be social issue. So you're going to debit social benefits, which will be in the revenue and expenditure. Okay, you don't debit asset because you didn't receive any asset. It is expertise, it is services you are getting. And so the service that you are getting, fighting sickness, is part of social benefits in that particular case. So it could be put under social benefit, or in some cases other expenditures, as a line item on the face of the other expenses on the face of the statement of financial performance in that particular case, right? And then what do we credit? Revenue in the name of grants and donations. And so donations in kind also, still we are applying the IPSAS 23 here. Okay, revenue from non-exchange transaction, and that is what we need to understand here. But beyond this, that we discussed this, that if, for instance, in the notes to the financial statement, two things could be happening there. Number one, maybe we have received a donation for which we've not satisfied the condition attached to the donation. Remember, usually donations are free money. We are not supposed to pay them back. But there are sometimes that certain donations will require the government or the entity receiving the donation to do certain things. So cash received, okay, the money has been received, but condition not fulfilled. In that case, what do we do? Because the condition has not been fulfilled, if we are in the accrual basis of accounting, what will happen is that money will not be recognized as part of the income for the year, because this will be a deferred income. It becomes a liability. So when we go on the face of the statement of financial position, although we've received the money, but since we've not fulfilled the condition, then we don't qualify to recognize it as revenue in the accrual basis of accounting. So that becomes a deferred income, and it will form part of the liabilities. It could be under the current liabilities on the face of the statement of financial position. So that's what we do there, and this will be a note issue when we are preparing the financial statement, that the ministry has received money, but the donors require the ministry to do A, B, and C. That is yet to be done in the coming years. Okay, so you've not fulfilled the condition, so heck, you cannot recognize revenue. That's why it's recognized as a deferred income, and that's a liability, right? Deferred income, and that's a liability. The second scenario is that we've not received the cash, but the donor has promised us, and even whatever condition they've given, we've satisfied the condition. So no cash received, but donor promised. Okay, all conditions attached to the grant has been fulfilled. Okay, so what do we do here? Again, in the accrual basis of accounting, there are two ways to deal with this. Normally, we will look at the reliability of the donor. If the donor is a reliable donor who we trust they will keep their promise, then it will still be recognized as grant and revenue, and then we take it under receivables. Okay, so it will be part of receivables. So you debit receivables, add it to receivables, credit your grant and donations, that is added to the grant and donation. That's the first treatment. So if we assume that this donor is reliable because of the country or the donor entity in question, and they are reliable, why not? Then we can recognize it. Again, if we're in the accrual basis of accounting, then it can be recognized in that particular case. However, the second scenario is, or the second assumption is, donation is not by force, right? I can promise you to take you to Dubai. It's not by force that I will give you the money. Yeah, I've promised, but what if my country is on fire? I should carry the money and come and give to you because I promised you. How about fixing your own country and make sure you don't rely on any donation? So that's the second assumption, where we say that although this person has promised us, we're not going to prepare the financial statement based on promises. So in that case, it is not going to be brought in the books at all. If anything, it will just be disclosed in the note. Usually 99.9% of the time we go with the earlier assumption, which is we expect that the promisor will come and pay the money. So for that reason, it is recognized or added to the grants and donations, and also added to the receivables. So 99.9% of the time we go with the approach that the promisor will fulfill their promise by bringing us the money at the end of the day in that particular case. So that is also what we need to understand. And if you remember, we discussed these things during session 2 and session 3. There are various other things under this, but because of time constraint, these are some few things I can bring to your attention here. Under IPSAS 23, IPSAS 12, inventories, IPSAS 17, property, plant, and equipment. Okay. Then we go back up into, I think I saw a question about, I thought I saw a question about IPSAS 11. What the heck? I don't know. My chat is not populating again. Why? Was it? What was in it? I think that question was coming from Jeff Towell. So, Jeff Towell, what did you say in the IPSAS 11? I think you said recognition of the profit. I don't know. I can't see my chat on the Zoom again. What happened? Oh, okay. So on the profit. Okay, so let me address that quickly. So when it comes to IPSAS 11, it's an accounting standard that is looking at how to recognize revenue from performance obligation that goes beyond one accounting year. And so the concept here is that we are going to be first calculating the profit or loss on the contract, right? The profit or loss on the contract. And the profit or loss on the contract, we mentioned that it is simply going to be the contract value, okay, how much we are charging for the contract, and then the total contract cost. Okay, now remember, the total contract cost will be the cost incurred to date plus the estimated cost to completion plus the net book value of any asset we bought specifically for the project. You got to be mindful of this because we crystallized this during our discussion. Okay, so the total contract cost will have three elements: the cost incurred to date, the estimated cost to completion, and then the cost, the net book value of the any plant bought specifically or asset bought for the project. Now the reason I said net book value is because the value we bring here is the cost of the asset we bought minus the scrap value. That's what we are bringing in the determination of the total contract cost. The cost of the asset minus the scrap value. So what it means is that if in the question there is no scrap value, then the total cost becomes the net book value figure, then we bring it there in that particular case. That's the concept you must understand. So these three items together give us our total contract cost. And certainly we're going to get either profit, which is positive, or loss, which is negative in that particular case. And if you remember, we said if it is a loss, it is treated as onerous contract in accordance with IPSAS 19, and so provisions will be made for that in the books to the entity, because onerous contracts are one-off contracts that result into losses for which provisions can be made for. Remember, under IPSAS 19 there are circumstances for making provisions in the books, right? For instance, for onerous contract, one-time contract resulting into a loss, we can make provision for that. It's allowable. Environmental or reclamation cost, we can make provision for that, and that is in line with IPSAS 17 as well, to bring that cleanup or landscaping or dismantling cost by discounting it into present value and including it in the initial cost of the asset. Then on subsequent measurement we do unwinding. Okay, we do unwinding, and so that is environmental cost. It could be brought, we can provide for that in accordance with IPSAS 19. 3 will be the issue in respect of repairs. Okay, major repairs. As we said, with repairs there is no present obligation, so by default we cannot provide for repairs. However, if the repair is something that is mandated, okay, it is legal, mandated that the entity must repair the asset or do an overhaul on the asset at regular intervals, then the entity can make provision for it. If there is no provision, you don't make. If there is no obligation, then we can't make provision for it. Then the issue about insurance. Self-insurance doesn't have present obligation. So if there is a self-insurance, like the company, the covered entity standard, they say, oh, we've been paying insurance for to the enterprise insurance or to SIC, BBI and CBM, until right now, instead of giving the money to the insurance company, we will open our own insurance account as an investment account and be putting the money inside, so that if something happens, we will liquidate that investment to deal with the thing. Yeah, that is investment, not insurance. And so for self-insurance, per IPSAS 19, we wouldn't provide for that as well. Then the last thing is going to be the last but one will be restructuring cost. So if we are going to restructure a ministry, a department, an agency, a local assembly, can we make provision for that in the financial statement for the year ended under review? Restructuring can only be provided for when the two recognition criteria are met. Number one, there is a detailed plan for the restructuring. Number 2, those expected to be affected by the restructuring have been informed by the decision of management to restructure the entity in question. So if there is a detailed plan and the plan has been communicated to the people expected to be affected by the restructuring plan, then certainly what is going to be happening is that we can provide for it. If there is a detailed plan without any communication at the reporting date, au revoir mon ami, we don't provide for it. If there is a communication without a plan, au revoir, bye bye, we also don't provide for it. So the 2 criteria must be met before we can make provision for restructuring cost. And then certainly the last scenario there will be the issue in respect of future operating losses. The entity cannot say, oh, a covered entity cannot set up and say, oh, because of the way the economy is, this is a new government, we expect that in the next 2 years we are going to be recording losses, so let's provide for that in the financial statement. We ain't doing that. So future operating losses cannot be provided for, but losses from onerous contracts, as I mentioned earlier here. Now the word is this is how the word is spelled. Okay, so depending on the school you attended and the teacher taught you how to pronounce things, you can call it onerous or onerous. Okay, onerous, that's what I will call it. So whatever school you attended. So one-time event resulting into a loss, it meets the recognition criteria, so we can provide for it. So what took me to IPSAS 19, it is the loss explanation, right? Then the last thing in IPSAS 19 is the issue about provision for contingent liabilities and recognizing contingent assets. If you remember, there is that threshold issue. Contingent liability is a possible payment we are going to be making in the future. The occurrence or non-occurrence of that particular payment and the events surrounding it is outside the control of the entity. But contingent asset is a possible asset that we are going to be receiving again in the future, but the circumstances surrounding the receipt of that asset, again, it's outside our control as an entity. And so if it is virtually certain, all right, above 90%, that we will have to make a payment, then we will provide for the contingent liability. If we are the ones to receive, then we can recognize the contingent asset. If it is probable, meaning above 50 but below 90%, we will still provide if we are dealing with contingent liability, but we'll disclose it in the note if we are dealing with contingent asset. If it is probable, okay, so certain, possible, and probable. Probable means it is below 50% in that particular case. Then with liability, we will disclose it in the note. With asset, we will ignore it because we don't do anything in that regard. Then the last one is remote, which is foolish case. So that one we will ignore it, whether it's a liability or an asset. So those are the guiding principle for the provision of contingent liability and recognition of contingent asset. Please be careful about those terminologies. We provide for liabilities or disclose it in the note. We recognize assets or disclose it in the note based on the probability of this event occurring. So that's IPSAS 19. Very sweet, simple, straight to the point. You don't like this? Which one do you like? But if it is a profit, then it takes us to step 2, which is now the allocation of the profit, right? Or let me say recognition of the profit, which is where Jeffter's question is. And we will recognize the profit based on the percentage of completion. And if you remember, we said when it comes to the percentage of completion, we have either the output method or the input method. The output method is where we are bringing the work certified or value of work up to date divided by the total contract value times 100. That's percentage of completion using the output method. The input method is where we look at the cost incurred to date over the total contract cost times 100. That is the input method. Now, it is important you understand this very well, because the way we do the allocation depends on the method that we are using. And so, for instance, if we are using the input method, then in that case, the preparation of our revenue and expenditure statement extract for this will bring the revenue, and that's going to be the contract value times the percentage of completion to get the revenue, right? Then you bring cost of sales, and that cost of sales will usually be the total contract cost multiplied by the percentage of completion, so that you will now get your profit for that period in that particular case. Now, be careful also that if we are in the second year, then part of the profits recognizable now had been recognized in the previous year, so you must know how much must be recognized in the current year. Now, the amount cost of sales here will usually go to goods and services. Okay, cost of goods and services in that particular case in the public sector. So this is the input method. That's how we do the workflow for the extract of the statement of financial performance. In the output method, the workflow is different. So if they are allocating the profit based on the output method, yes, we'll have a rev. So permit me to just duplicate this. So we'll have our rev coming up, but this time around, because we are in output method, we would get the profit, which is going to be the profit that we recognize in step 1 multiplied by the percentage of completion, so that in this case the balancing figure becomes the cost of goods sold, okay, sorry, or cost of sales. So in the input method, the balancing figure is profit, and look at the calculation the way it's done. But in the output method, this is how the workflow is done. That is the idea when it comes to dealing with the issue in respect of the output method, and that's step 2, preparation of the extract income statement. Okay, preparation of the extract income statement. Then the final thing is going to be the statement of financial position, right? Extract. So in the statement of financial position extract, you're going to be bringing what you know already: cost incurred to date, the profits that you recognized, then the depreciation on the plant. If we bought a plant for the asset, the depreciation on that will come here. So if that, because this asset is not used in the day-to-day running of the organization, if it is used in the day-to-day running organization, then that asset will calculate consumption of fixed asset or depreciation, and that would have come as a line item on the face of the statement of financial performance. But if the asset was bought to execute the contract for the customer, then the depreciation on that asset doesn't come in the statement of financial performance, but has to be adjusted for here when we want to get a contract asset or liabilities for the client. Then we look at the invoice that we've sent. So this is a positive figure, positive figure. Now, if it was a loss recognized, then it will be deducted. Depreciation is added. Invoice that we sent to the customer will be subtracted. And this is what gives us, if it is a positive, it will be a contract asset. If it is a negative, it will be a contract liability. Then, if it happens that we sent an invoice to the client and we got less than the money on the invoice because of retention, then certainly what is going to be happening is that we are going to be having retention money or receivables. So as part of our receivables in the statement of financial position, it will be the invoice we sent to the person minus the cash that we received from the person in that particular case. So those are some of the things that we need to understand when it comes to dealing with the IPSAS 11 as well in the calculation workflow and then bringing up the IPSAS 19 in that particular case. So Jefta, let me know if you are okay. Recognition of profit and the treatment of the financial statements. Okay, so those are the things that you must understand in respect of the question that you asked. So let me know if that makes sense for you. And then if there is a follow-up also to this, you can bring it up in that particular case. All right. Okay, that makes sense. Okay. All right, then, we go to some of the other IPSAS. If you remember, we spoke about IPSAS 16, investment property. We said if the entity has an asset and they are not using the asset for the day-to-day running of the organization, but they are holding on it for capital appreciation, or they are undecided on what to use the asset for, or they have leased out the asset under an operating lease, then that asset must be accounted for as an investment property in accordance with IPSAS 16. By default, investment properties should be carried at fair value, which means on subsequent measurement, any fair value gain or loss will be recognized in the statement of financial performance. However, where it is not possible to determine the fair value of the investment property, then the investment property will be carried at its historical cost less accumulated depreciation and impairment. So in the cases where we have an investment property but the fair value cannot be determined, then the examiner may give us the economic useful life of the investment property. They would depreciate it the same way we would have depreciated the assets that we are using in the day-to-day running of the organization, like we would do in IPSAS 17. So yes, sometimes investment properties can be depreciated depending on the context of the question and what we need to understand. So that's also about investment property. Very sweet, simple, straight to the point in that particular case. IPSAS 2, the cash flow statement preparation issues, we looked at those things and the various things that you must understand, looking at the cash flow from operating activities, cash flow from the investing activities, which is about acquisition and disposal of assets, all assets, financial assets and non-financial assets. Everything is coming under that. Then under the financing activities, technically we are just dealing with how much loans we issue during the year, that's an inflow. How much loans did the entity repay during the year, that's an outflow in that particular case. And that is what we must understand when we talk about the IPSAS to the cash flow statement preparation. And so that is something, as I said, on the financial statement preparation that the examiner can ask us about, that we need to know about in that particular case as well. Then certainly we come to the other IPSAS, like the IPSAS 21, the effect of changes in exchange rates. You know that already. The initial measurement, you translate the transaction into the functional currency of the entity, which is the Ghana cedi. Then on subsequent measurement, the way we deal with it depends on whether it is a monetary item or non-monetary item. If it is a monetary item like receivables, payables, right, and those items, then they will be retranslated at the reporting date, and then any foreign exchange gain or loss will be recognized in the statement of financial performance as an expenses or an income. It will be added to other income in that particular case. But for non-monetary items like inventory, investment properties, we are going to be accounting for them on subsequent measurements that we bought in an original in a foreign currency in accordance with the applicable IPSAS in that particular case. However, it must be noted that where a non-monetary item On subsequent measurement, its value can be determined in the foreign currency, then it will still be translated in the foreign currency, and then any foreign exchange gain or loss will also be recognized in the statement of financial performance. So that is also the idea about this. And the rest of the IPSAS, it's a lot. I mean, these are some of the things that probably I can share my thought on the IPSAS situation. So back to this place, covered entities, decentralized transfers, IGF, grants and donations in that particular case. Remember, although trust funds and borrowing are revenue, for the purpose of preparation of the statement of financial performance, we don't bring them as revenue. Trust fund is a liability, so it will go in the statement of financial position. Loans that the entity had gone for during the year also is a liability, so it will go to the statement of financial position. On the central government side of things, this is where we're going to be having direct taxes, right? Indirect taxes. Last semester it was a covered entity that the examiner brought on the financial statement preparation. Now that doesn't mean this semester the examiner will bring a question on the central government. As I keep on telling you, the examiner owes you no apology or whatever the heck you think that he should bring. So you have to know the two at the end of the day. So for instance, when it comes to the IGF, it depends on the entity in question. If it is a school we are dealing with, or a college that we are dealing with, whatever the heck, then their IGF will include admission forms, okay, tuition fees, sale of books, sale of uniform, hostel fee, and all other things. That will be part of their IGF. If we are dealing with a covered entity that is a health facility, okay, then their IGF will include admission, picking of the card, consultation, laboratory tests, and the various after outpatient, what is it called, OPD, outpatients department. All of those other things will be revenue to them. So when it comes to the covered entities, the IGF will be different. If it is a local assembly we are dealing with, then their IGF, we may see things like licenses, okay, market tolls, miscellaneous fees, property rates, basic rates. So we discuss all these things, and you have to be mindful. So whatever covered entity we are dealing with, their IGF will vary. But in the central government, direct taxes, indirect taxes, non-tax revenue. Remember, I keep on telling you this. The problem here is about classification, because 99.9% of the time you could conclude it's a revenue or it's an expenditure. But if something is a direct tax and you come and put it under indirect tax, don't worry, you just got the direct tax figure wrong. Congratulations, you just got the indirect tax figure also wrong, but your total tax revenue or your total revenue figure will still be right. In that particular case, your total tax figure will still your total revenue figure will be right, but you lose the tick for the direct tax, you lose the tick also for the indirect tax. So the classification is very important. Same thing happens to the covered entities. If something is under IGF and you go and treat it under donations or decentralized transfers, well done, you just got the two ticks wrong, but your total revenue will still be right. And it's about the ticks. So if you remember, we said you want to take your time on this pretty well when you are working it out to make sure you are doing the categorization pretty well at the end of the day. So non-tax revenue going to come there in that case. Then certainly the central government also receives donation. These days they say they are building a resilient economy, not rely on any external people, but definitely donations will come for us at the end of the day. So on a central government, direct taxes, indirect taxes, non-tax revenue, and then grants and donations. So that's the first thing. When we're in a covered entity, decentralized transfers, IGF, grant and donation. If it's on the central government, we are preparing for the consolidated fund of the government of Ghana, then we are going to be looking at the issue in respect of direct taxes, indirect taxes, non-tax revenue, and then grant and donations. For the expenses, they are almost always going to be the same. Okay, the expenditure part: use of goods and services, compensation of employees, interest on debt, consumption of fixed assets, other expenses, social benefits. What else comes there? Whatever the heck. So the expenditure part, it's not going to be a problem too much in that particular case. It's the revenue part that will vary, whether we are in a covered entity environment or a central government environment in that particular case. So when it comes to the financial statement preparation, we are doing this classification in accordance with the chart of accounts of government. And if you remember, we discussed the chart of accounts. It's a question the examiner can ask you. It's part of the 10% area, the regulatory framework scenario there. So the chart of accounts of the government, then the gift miss is an important aspect of the budgeting cycle, which is the part of the budgeting question. The gift miss. So make sure you read what is it for, what are the objectives, what are the limitations, So gift miss and chart of accounts, we discussed these during our revision session. Make sure you go through them again, because the examiner could hit you up with some 5-mark question, baby, and you want to be able to answer that generally. Okay, so that is the financial statement preparation with the IPSAS. Okay, the financial statement preparation with the IPSAS, 40 marks waiting for us in the exam hall in that particular case. As I mentioned, the trick here is knowing how to classify the item, and then certainly the standards, knowing how each of the standards actually come up together at the end of the day. And that is the idea about that. All right. So any questions in respect of the financial statement situation? Because I think that will be all in that particular case. Please remember also what I mentioned about the financial statement preparation. It depends on the accounting basis that is being used. Now, the way the examiner can come for you is either 16 marks on the financial statement, then 4 marks will be a theory question. Last semester that was the same thing he did, and he does that a lot of the time if we go back to the previous syllabus workflow. So you may have a B aspect of this financial statement question, which will be a written question on a standard or something else. For instance, if you remember, we said what are some of the things that must be disclosed in the notes to the financial statement. We discussed this, okay? Or any IPSAS issue that relates to the financial statement preparation, the examiner could throw that in the B aspect. So expect 99.9% probability a theory question, 4 marks or 3 marks under the financial statement preparation question. So the A and B will be maybe prepare statement of financial performance or and position, or statement of financial performance and cash flow statement for 15 or 16 marks together. Then the other 4 or 3 marks, whatever the heck, will be a written question that the examiner will throw at you in that particular case. If the examiner doesn't want to do that, then you will just get a financial statement as a whole for 20 marks, 10 for the 2 financial statements that you are going to be preparing. So that is our IPSAS and also the financial statement preparation part, and the various things that we must understand about the IPSAS 23, IPSAS 12, IPSAS 17, or flip it up over, dealing with the issue in respect of benefit in kind, expertise, and then in the notes, when there is a donation, we've met the condition but hadn't done the job yet, or hadn't received the cash yet, how do we treat it? But on the overall, be mindful, what basis of accounting are we using? Is it cash basis? Is it accrual basis? Is it modified accrual basis? It will be stated there, and you must then prepare the financial statement based on whatever basis of accounting the entity or the central government there to be accrual. So if it is a consolidated fund, then it will be accrual. But if it is a covered entity, then that is where it could either be modified accrual, or heck, cash basis, if the examiner wants to dance with you in that particular case. So that is that 40 marks, the IPSAS, some of the IPSAS that I just ran through with you, and the financial statement. Now I think our time is pretty gone, so I'll talk about the last important aspect of the syllabus, and then probably we call it a night and leave you so you go and sleep, and that is going to be the evaluation of performance. Okay, evaluation of the financial performance and position. This is an important area of the syllabus. 20 marks waiting for you in the exam hall, whether you like it or not. 20. Done deal, waiting for you in the exam hall. 3 options are available to the examiner as always. Either the examiner will ask us to prepare a common size statement. Okay, so common size financial statement. Or the examiner will ask you to calculate some ratios. Right? Calculate some ratios. Or option number 3, prepare statement of budget performance. Now, don't get this twisted, because the budget performance you prepare here is slightly different from the budget performance under the PIFA. Now, under the PIFA, you remember we'll get the out 10, then you'll get the score. So we can prepare the statement of budget performance in the PIFA environment, which we spoke about earlier. There will be a score column. But the normal statement of budget performance, there will not be any score. So in that case, we'll have the out 10 in currency and the out 10 in percentages. And that is the kind of statement of budget performance that I'm talking about here. One of these 3 will be in the exam hall for you to do for the A aspect of the question, give and take maybe whatever between 6 to 10 marks. Then the next 10 will be the analysis. So you're going to be writing an analysis of the performance of the entity. Now, as you know already, common size statement is where we are expressing the financial statement in what? Percentages. Right? And so if we're in the statement of financial performance, that is, we are preparing the common size statement of financial performance, then the total revenue becomes the basis. So we are taking each line item as a percentage of the total revenue. In other words, when we take the total revenue, how much, what is the percentage of, say, grant and donation of total revenue? What is the percentage of, say, goods and services of the total revenue? How much is the entity spending on goods and services? What's the percentage of total revenue that the entity is spending on wages and salaries? What is the percentage of total revenue the government is spending on interest and those things? So you are changing each line item into percentages using the total revenue as the base. If we're in the statement of financial position, here we are using the total assets as the base. So you are taking each line item on the face of the statement of financial position as a percentage of the total asset. So if we take non-current assets, go. What the heck was I even talking about? Yeah, the statement of financial position. So in the statement of financial position, the total asset becomes the base, and you take the line item in that particular case. So that is common size statement. So either the examiner asks us to prepare that, or second, we calculate ratios. Last semester ratios was there. That doesn't mean ratios cannot come this semester, because the kinds of ratios that came last semester are different. You know, when it comes to the ratios, we have the financial performance ratios, we have the financial conditions ratios, and then the cash and fiscal policy or fiscal performance ratios, right? So ratios can still be there this semester for you in that particular case. It's not far-fetched. It's not something the examiner could overlook. He can still bring ratios. So know your formulas and know how the various calculations must be done when it comes to the ratios in that particular case. Let's see, give me a second. Gotta change my network temporarily. Is it gonna come? Give me a sec. I want to move to a faster network. In that case, so 9 marks for the common size or the ratio or the statement of financial performance, 11 for the analysis. All depends on the examiner, right? All depends on the examiner. But the most important thing is the way we write out our analysis. And some of you have been through this. We've written the analysis over and over again. You know the things that you have to be mindful of when it comes to the analysis. So let's see if I can quickly bring the analysis guidelines up again as we wrap up on this one. So the analysis guidelines, give me a sec, let me just shoot that up so I don't have to write again on this. There we go. So this is the analysis guideline that you have to be mindful of. So in writing out the analysis, these are the things that we need to be mindful of. Number one, you mentioned the change, okay, in the comparatives that we have available. Remember, if we are comparing two different entities or two different countries, our choice of words will be different from if we are comparing the same entity year on year. So you remember we did country N and country G. You cannot say the debt to equity ratio has risen, debt to the equity ratio is rising, debt to the equity ratio has increased. No, you won't do it, because when you're comparing two different things, there is nothing increasing, there is nothing decreasing, there is nothing rising, there is nothing falling, right? But if it is the same entity year on year, then you are at liberty. It's rising like like the sunshine. It's falling like the mango. It's decreasing. It's increasing. That to do with that one is your choice. But that's the first thing. Higher, lower, rising, falling, increasing, decreasing, greater, less, Two, which is the most important thing. Why is that happening? The possible reasons for the change. The possible reasons. So if it is a statement of statement of the common size statement you prepared, then you are looking at the percentage of revenue that went into goods and services, percentage of revenue that went to wages and salary, percentage of revenue that went into interest expenses. Remember I said if we are doing the common size analysis, the expenditure ones, you don't talk about all of the expenditure items because you don't have time. So you could pick the top 3 items and talk about them, like goods and services, compensation of employees, interest, and then probably if there's a social benefit you could talk about it, because there's a lot of expenditure items there. You don't have time to talk about all of them, so you could just pick the significant ones and talk about them and go away. So what is the reasons? Please, as I say always, and we've looked at it, and some of you have written the analysis over and over again, you are going to be making statements to ensure that you are not contradicting yourself. You cannot say something in one ratio, come to another ratio and give a reason that contradicts with the reason you gave when you were interpreting certain ratio up. So there has to be that connectivity. They are intertwined. There must be goal congruence in your analysis, where all the things actually comes together in the overall performance of the entity. So what are the reasons? Then the last one is the economic implication, or the implication on the entity based on what is happening in the change. Like I said, that one, it's a little bit extreme. But if you feel you are good and you have grasp on the discussion, boom, you can go for it. If not, you can just end on the reasons and go away. So these are the guiding principles we follow to write out our analysis. And we've said this over and over again, that whether I like it or not, you will write analysis for 10 marks. So it's waiting for you. Now, it depends on whatever the heck we are writing. It could just be comments on the performance of the entity. Then you just have your headings up, your introductory paragraph will come, then the various things you're analyzing will come, your conclusion paragraph we'll talk about two things: the overall performance and then recommendations. As we have said over and over again, you are not making generic recommendations, you are making specific recommendation. The government should put measures in place to increase revenue. Don't go and write that thing. What measures? Government should put measures in place to control how much revenue is spent on goods and services. What the heck is that? So specific. Please, specific recommendations, suggestions. That's very important at the end of the day. So that's what is happening in the conclusion paragraph. But remember, it depends on the question, because sometimes the examiner could put another condition. They will ask you to write about, what are the limitations of the ratios, or what are the limitations. If you remember the country N and country G question we discussed in class, and some of you wrote analysis about that, there was a requirement on the limitations of analyzing the performance of the two different countries, and we spoke about currency, right? Their economic policies, their public financial management system in place, the laws that they are operating with, right? The efficiency of their revenue collecting agency or collection agency in that case. So there could be some other nuances that the examiner will throw in the analysis part. Normally that will come before the conclusion paragraph. So when you finish the analysis, then whatever nuances that the examiner wants you to talk about as part of your analysis will come before the conclusion paragraph. Then if it is just an analysis we are writing, your closure is just thank you, au revoir mon ami, you are gone. But if it is a report, certainly you know what the heck you are supposed to do. Who are we writing to? From who? If you are given a title, put it there. If you're not given a title, you can give yourself a title and then you put it there in that particular case. Then the subject, then the date, you have your intro. Remember we said your intro should tell us about the purpose of the analysis you are writing, what are the basis of comparison, what are you comparing here, and then the year ended in question in that particular case. And so you make sure that your introduction is sweet, simple, straight to the point. Now if it is a report we are writing, then our closure is going to be thank you, yours faithfully or yours sincerely or whatever the heck. Your signature will come, then you put your name down in that particular case. So pro forma is key about the analysis. If it is a report, the examiner wants to see the pro forma of a report, and sana he comes to the English that you've written. If it is just analyze the performance, the examiner wants to see the pro forma before we come to the analysis at the end of the day. And those are the things that we need to understand when it comes to this 20 marks area that we're going to be having. Either common size statement, ratio calculation, or statement of budget performance. In either case, we are going to be writing the analysis, and the guiding principles applicable is the same. And for those of you who have written the analysis, you know what you are supposed to do generally in that particular case, and you have to go in there and do what you must do in that regard. So that is the idea about the evaluation of performance of the entity as well, and the things that we need to understand. And that brings me to the end. We've looked at 90% of the syllabus. The other 10% is the governance issues, the role of the various key people, right, that we have discussed. You know them already. And then the principles that we have to use when it comes to dealing with the governance, public life, principles of public life. We've discussed all of those things as well. So we've gone through the 90% in detail. The last part is the governance area that you want to make sure that you also read on. That's 10% in that case. So we've discussed all the 90% in detail, what we are expecting, what we are supposed to crystallize on. The last part is the governance area, 10% in that particular case. Now, in putting the pieces together, as I mentioned, what we want you to do in the exam hall is, number one, you read all the questions thoroughly. right? So you read all questions thoroughly in that particular case. All of the questions. Make sure you read all the questions so you know what you're supposed to do. Number 2, as much as possible, there will be a lot of written questions. Maybe not a lot, but maybe 40-50% of the questions will be written questions. So as much as possible, you answer all the written questions in that particular case. Again, you are not under obligation to answer questions in any order, right? But you must make sure that you are not answering 2 different questions on the same page. For instance, I told you that the financial statement preparation, the B of that or C of that could be a theory. So let's say that is question 1. So question 1C, you answer that. Okay, then there's another theory in question 2B that you can answer. It must go to the next page. You can't answer 2 different questions on the same page. So as much as possible, you want to take out all the written questions in that regard. Then from there, based on your workflow, you can come to the IPSAS or alternate to the evaluation of financial statement part, which one you can do first in that particular case. Then certainly you want to answer the financial statement preparation as your last but one question, as we say all the time, right? Because the reason is that the evaluation will require a lot of time. Even the preparation of the statement of budget performance, or the calculation of the ratios, or the preparation of the common size statement, it will take time. The punching, the classification, that will take time. Then the financial statement preparation also, that will take more time. So you don't want to answer the evaluation and the preparation of financial statement as your first or second question. I beg you, don't let anything lie to you when you get to the exam hall to think you can work faster. Because in the exam hall, it is not about swag. It's about where can I get some free marks, some easy marks, get my marks and go away. And nuntina, you have to read all the questions thoroughly. That is why you have to answer all the written questions that you can answer best first. Because it's fresh in your head as you enter the exam hall. So you can answer these as fast as possible and take them out. Then you can come to those 3 areas that will require resources, will require time, will require thinking, will require some level of extra dedication. The IPSAS, the evaluation, and certainly the financial statement preparation. So that is the best practice that you have to follow. But as I say always, if you get to the exam and whatever the heck comes over you, we pray that whatever approach you use, the end goal is to be able to pass the exam, and you'll be able to pass the exam at the end of the day. But read the questions thoroughly, answer all the written questions, take them out as fast as possible to save some time, get some easy marks, and go away. And then you come to the IPSAS or the ratios. Between that, you can decide to do the evaluation. You can decide to do the evaluation or the IPSAS or whatever the heck. And then the financial statement preparation. Again, whatever you do, let that be your last question. Whatever you do, let that be your last question or last but one question. Okay. Above all these, as you know already, I've mentioned this in other subjects, you want to make sure you take care of your emotions, right? Time is going to be your enemy in the exam hall. Not that it will be your enemy like that though, but time may not be friendly with you in the exam hall. And Nuntina may say, read all the questions. That is why I'm saying answer all the written questions as fast as possible. If you're able to do that, you reduce your panic levels. You reduce your emotional stress that you could suffer. You reduce your time that you will be worrying about. Because the reason people start panicking in the exam hall is because they look at what they have done and the time remaining, they are screwed. And then boom, they are looking for solution, but there is no solution anywhere. And so if you don't approach the questions in the right order, then you will fail. Then you have to go in July. But that's not what you want. Nobody wants that. That is why we are recommending that you go with this approach. If you do that, I can guarantee you, you'll be in a better position to pass the examination at the end of the day. So certainly read through all the questions, answer all the written, then from there, go in that order. Please make sure that you do the financial statement preparation as the last question, focusing on the key issue in respect of how we classify the various items based on the chart of accounts of government. Control your emotions. If you start panicking, kill that in 10 seconds. If not, it's going to escalate and everything is going to be frozen in your brain and you cannot think. It's not the devil after you. We respect you though, but that's not the devil. He doesn't even know your address. It's not the devil. It's just your own emotions playing tricks with you. Take charge of it. Control it. It's not the devil. It's not everything you have to blame the devil for. Control your emotions by following best practice. If you do that, by the grace of God, you should be able to go into the exam hall, write the exam with confidence, answer as many questions as possible, come out with confidence, and most importantly, pass the exam at the end of the day. And that is the idea about what you must understand when it comes to public sector accounting. And we're going to wrap up here for our discussion, and wishing you all the best as you go in there, and let's see how you can work yourself out following the best practice that we've given you and the executive revision that we've done today to put you in the position to ultimately pass the examination at the end of the day. All right, so that is the issue in that particular case. Yes, Eric, your hand is up.
Yeah, Nhyira, I sent a text on WhatsApp this afternoon when I was in the office, but I think your people are not responding to my text, which makes customer service very boring. I sent a very pressing text about the ratios on the final account. And from the textbooks I was using, I was getting some of the solutions right, some were wrong. So I want them to confirm from the textbook. If the textbook I screenshot to them is the one making the mistake, then I know I'm right. But if the textbook is right, then I ask them for clarification on the item.
You know the problem I have? I was the one looking at your message and I was the one who replied your message. You sent a question with a solution from a textbook I don't know about, number one. And you said you are looking at it from your mind. You think some of the things are wrong, some of the things are right. So it should be looked at. You can't be assisted like that. So what is the specific issue? It's not like we are sitting down, then you send a question from a textbook with a solution, then we'll sit down and solve the question and send it back to you. That's if you call that poor customer service, I don't know what the heck that is. Because you have to ask something specific. I don't know the book you are referring to. Then you tell me you are looking at it with your mind, and you saw that it's like there could be difference, so it should be looked at for you. So I sit down, then we solve the questions and send it back to you, or what? You don't sometimes understand what we are doing. If there is something specific you don't understand, there is something specific calculation you don't understand, it could be handled. But you don't send me a question with a solution and say that we should check the question and the solution. I don't know the book you are referring to. I don't know the source of the question. I don't know the basis of it. Then you say we should check all of it for you. We can't work like that. Who works like that? So that's why I replied your message and I asked you, what is exactly your problem? We can't sit down and solve questions and send you solution. We don't have time for that. We can't do that. People are sending question, asking specific question, and they are being addressed. But you send a question from a book with a solution from the book, then he said it should be looked at for you, whether which is right or which is wrong. I don't know the book. I don't know what you're talking about. Come on. Sometimes you people should make the job easier for us. Some of you should make the job easy. Because if you ask such a question, I don't know how to help you. I don't know how to help you. Frankly speaking. That's why I asked you, what exactly is the problem? And if you're able to state what exactly the problem is, I can sit down, pick my iPad, and then look at a screenshot of the question and start solving all the questions and send to you. No. If there is something specific you have, you state it, it will be addressed. But you can't say we should look at the whole question, the whole solution. We don't know the book the question is coming from. We don't know the source. Then you say we should look at it because in your mind there is something there that should not be there, or there is an answer that should not be there. I can't help you. I can't help you. Because other people are sending questions, asking specific questions. So that is the thing there. If you send something generic, I can't assist you. Because we don't have time to sit down, solve a whole question and send to you. It's not done anyway. We don't have that time available. Because other people are equally asking specific questions that has to be sent. Now I have to sit down and start solving a whole question, ratio question that you've sent. No. So if you have something specific, that's why you were asked, what exactly is the problem? Then you state it. Because I don't know the book you are using. I don't know which book is that, where the question is coming from. So if you don't have something specific for me, then I can't assist you. And that is not poor customer service. That's not poor customer service. That is your inability to clarify what your problem is. And we can't help you. We can't help you. So please, some of you should make the job easier for us. And stop this whole customer service issue. It's not poor customer service. It's your problem. It's your problem. Maybe even if you were referring to my book, probably it could be looked at easily. Because in my book, the solution in the book, there are descriptions given to all of them. So it could be looked at and clarified. But this is somebody's book. I don't even know the source of the question. How can I clarify that this is why, or this is how they arrive at this answer? Because there are other people equally asking questions. All right, so that's it about that. Please read all the questions thoroughly. Answer all the questions, written questions first. Then you move with speed and accuracy in that particular case. And please, as I said, let the financial statement preparation be your last question. I beg you. Okay, never let anything come over you. I beg you. Let it be your last question. It's just a plea that I'm pleading with you, because it will require time. You remember when we were solving some questions in class, how much time we used on these things, right? So please work that out pretty well in that particular case. And if you do that, I think you should be able to pass the examination. All right. So that's it about that in respect of public sector accounting. And wish you all the best as you go. Before 9 a.m. tomorrow, certainly, if there is anything specific that you want to pick my brain on, definitely you can send it over. I'll be on standby a little bit. So if there's anything before tomorrow morning, 9 a.m., you can reach us out. You can reach out, and something specific that you want to pick my brain on, I'll be able to assist you in that particular case. All right. So all the best. We'll see you in some other paper, not public sector, and wish you all the best. All right. Good night, and please go and sleep. We are done. So go and sleep so that tomorrow morning Obafe fresh for the exam. Okay? Go and sleep so that tomorrow morning your brain will relax. You need your brain to relax a little. Sorry for taking you more than the time that I have to take. But because we had a lot of things to talk about, so that's why I went beyond. It's almost 10. So that's it about that. Also, they sleep. Hey, you will sleep. Sleep, Jonathan. Sleep, because sleep is good. All right, so that's it about that. We'll see you some other time. And as I said, anything before tomorrow 9 a.m., please reach out and you could be assisted in that particular case. Also, my regards to Kukua. Who is Kukua? Now you're giving your regards to Kukua.